We now come to our first panel discussion entitled Macroprudential Policy Beyond Banking, which will be chaired by Vice President Luis de Guindos, who is kindly stepping in for Verena Ross, Chair of ESMA, who could not be here today. The Vice President will introduce the panel members. And before I hand over to the Vice President, let me remind you that you can ask questions at the end of the discussion here in the room. And those who are watching remotely, you can send us questions via Mentimeter. And then we can take those questions also here in the room. So without any further ado, I hand over to the Vice President.
Thank you very much. Good afternoon to everyone. It's a pleasure to be here with you to moderate this first panel of discussion. Unfortunately, Verena cannot be with us, and so unfortunately for you, I will be the moderator. So having said that, let me introduce first, the different panelists. We have Petra Hielkema, the chairperson and president of EIOPA. Steffen Kern, chief economist and head of risk analysis at the European Securities and Markets Authority, ESMA. Thank you very much, because you have come with very short notice. Javier Suarez, professor of finance at the Center for Monetary and Financial Studies, and also member of the advisory scientific committee of the ESRB. And Dimitrios Tsomocos, professor of financial economics at the University of Oxford. So welcome to all of you. But before giving you the floor, let me make some initial remarks to try to focus the discussion. Theoretically, we are going to talk about theoretically no. In principle, we are going to talk about macroprudential policy beyond banks. I suppose that we are going to focus on macroprudential policy for non-banks. Well, first of all, non-banks is I would say, is a mixed bag. We have different kinds of animals. Petra knows perfectly. It's a point that always she makes. Because I think that it's a little bit unfair, no, to use the generic reference to non-banks, to some institutions. We have some institutions like pension funds and insurance companies that, they are perfectly supervised with a lot of regulation. We have as well what we can call, asset managers, mutual funds, and even in the mutual funds there are a wide variety of different mutual funds according to the investment strategy of each one of them. We have money market funds, fixed income funds, equity funds, property funds, hedge funds. Even we have something that is going on and growing very rapidly, that is private equity and private credit. So the reason to pay attention to the macroprudential toolkit, the macroprudential framework for non-banks, is the increasingly higher relevance and market share of these banks. We know perfectly that theoretically, in principle, we have always said that the US economy is a market-based economy, whereas in the case of Europe, it's much more banks, have, let's say, the upper hand. This is changing. This is changing rapidly, and I think that now non-banks, especially mutual funds, asset managers, they are playing a bigger role, and that's why it's very relevant, what's happening with these institutions, that they are funding the economy, that they are, an important part of the financial system in Europe, and that's why the macroprudential policy, is going to play a very relevant role. And that's why I think that we are going to dedicate this session to that issue. Let me say simultaneously that banks and non-banks are closely intertwined. There are very clear links between banks and non-banks. And so if we apply the correct macroprudential policy and the macroprudential framework to the non-banks, and we improve the resilience of the non-banks, simultaneously, what we are doing at the end of the day is to improve the resilience of the banks. So I think that in that respect, we can say that there are a positive externality in terms of the macroprudential policy for non-banks. Today, to introduce the discussion that we are going to have afterwards, and for sure that will be further developed by the panelists, I would like to stress three areas that, in my view, are especially relevant in the macroprudential framework for non-banks. The first one is liquidity, And it is clearly needed to address the structural liquidity mismatch in the investment fund sector. This refers to increasing the liquidity buffer requirements for money market funds, but as well, to reforms, in other parts of the mutual fund industry. The second area of attention that for sure will be also alluded by the panelists is MBFI leverage. Here, let me say that this is one of the issues that the most relevant issues, because we can refer not only to explicit leverage, but also what we can call hidden leverage. That is the one that has been obtained through the use of derivatives, and that can give rise, to an increase in terms of vulnerability of the mutual funds, especially, the complex funds that pursue hedge fund-like strategies. And finally, another part that, another issue and topic that I think that is important is the need of avoiding regulatory fragmentation. And I think that in that respect, we are going to have, or we are going to need, a much more integrated supervisory approach. This includes developing a mechanism to ensure a coherent use of policy tools across jurisdictions. Additional powers should be granted to the European supervisory authorities, and moreover, ESMA and EIOPA could be involved in the supervision of systemic cross-border capital market players. Finally, let me say, well, I suppose that all of you, you have heard and you have read an important part of the reports by Mario Draghi and Enrico Letta. And one of the main points is about strengthening the capital market union and to make progress in the capital market union. Now it is called, I think, Savings and Investment Union. So it's as you can imagine, this is a big progress in terms of changing the name and the headline of the project. No, but I think that capital market union is something that we have had a lot of discussions and very little delivery. And in that respect, to have a consistent, coherent macroprudential policy tool for non-banks, I think that is an important step for the capital market union. It's going to be very difficult that without this macroprudential framework, capital market union could advance. Finally, given the point of that I made at the beginning of the heterogeneity of the sector of the industry, it's very important, to transparency in order to help authorities to identify the most critical market segments and institutions. This is a mixed bag, as we said at the beginning, with different kind of supervisions, and I think that in that respect, transparency, that is always a very good characteristic. In this case, is going to be especially needed. We have an important opportunity. That is going to be, the response that the different institutions we are going to make to the consultation process of the European Commission. Let's see what happens with the new Commission. I think that we have to put a lot of hopes. I think that Marisa Albuquerque, the new commissioner, is a person knowledgeable with respect to financial issues, and for sure that the new Commission will give relevance to the macroprudential framework for non-banks. And with further ado, Petra, it's your turn. Huh?
Thank you.
You have a maximum of 10 minutes. I am totally sure that you have the, okay. And it's pretty big.
Yeah, it's good, huh?
Okay,
yeah, so
Petra,
thank you
very much.
And a pleasure to be here. Good to see you all, and thank you for the invitation. I can't see who is online, but just in case they're not all macroeconomists, I want to start with what I try to say when people ask me, what are you doing? And maybe some people even get as far as what is an ESRB. What I always say is that in the crisis, that what we learned from the crisis is that you need to not only look at one entity, but you also need to think about supervision. And then I always say two animals, according to fish and eagles. And that might sound strange, but the fish, if you look at one fish and it swims and it turns, then you see fish swimming and turning. But if you zoom a little bit out, most of the time, fish are in a group. If one turns, I don't know if you've noticed that or you observe it, they all turn immediately and go the same way. And this is something you also want to identify. You can't see that if you don't zoom out. And they do that in an environment that impacts also, and there can be other things that impact that. And so you need the view of an eagle that sees the movement of different groups of fish or any animal. And this is how I explain that you need to add that, and that is what we learned from the crisis. We need to add that. So for me, this is the conference and the committee of the eagles, and we try jointly to actually see where we actually need to zoom in to understand what is happening. And you need to do that jointly. And we tend to start with banks, and then we realize there's something out there, and then how are we going to name that? And we name it non-banks. And I always make the comment that there's a lot of different non-banks, and some are completely not under supervision and not reporting. We don't have a lot of data, and others are very much under supervision, and that is also insurance and pension funds. And that is where, as a European Insurance and Occupational Pensions Authority, I'm responsible for. The picture was a little bit larger. You would see our tower at the end of the picture. And I think that it's always very symbolic that you have on the one end of the mind, you have the ECB, on the other you have EIOPA, and with that you already capture, I think, looking out to the middle, where also Claudius, but also a lot of banks and insurers, that we together watch out over an industry. And we need to do that jointly. And I'm very happy with the cooperation we've had already for a long time, since 2011, with Francesco and the team. And it's important. And we can do more. So zooming in then on the insurers and on the pension funds. Just to share, I know you like numbers, but there's about 9.5 trillion under assets in the insurance sector, and then another 2.5 with the pension fund. So together there's about 12 trillion in assets. And if we then look at how are the insurers particularly linked to the banking, then we see that about 12% of that those assets are actually invested in banks. So if there is a concern about cross-sectoral impact, it's definitely trouble in banks is impacting insurers. And there is that link that we always monitor. Sometimes there's things happening on the banking side, and we then monitor whether or not that impacts us. The other way around, we see less links. We see more that behavior of insurers in itself can create an impact on the market, and that for sure can also impact the banks. And that is what we need to look out for. Now, in the Solvency II framework, we already have tried to address some of the liquidity, fire sale, and other concerns that we don't want to see in times of a crisis. And so within the Solvency II framework, we introduced what we call a volatility adjuster that recognizes a certain illiquidity for the assets of insurers because they hold them long term. They do not tend to sell those, and we reflect that in a capital requirement. For those who want to know more, what we say is if you take the swap rate and you then look at the spread, 65% of the spread you can ignore for your long-term investments, and in the Solvency II review that will actually go up. And I think that is fair for the long-term assets and investments. I'm a bit more worried about the short-term. They tend to get in there now as well with politics negotiating, but I'll leave that for a different table. The other thing we have is an equity dampener, and that means that if equity value goes down, the capital requirement goes down with it, and symmetrically, and if it goes up, the value, it goes up a bit. And so with that, within the capital requirement, within the first pillar of Solvency II, which is the only pillar where we actually quantify risk, we try to ensure that we are not having, that the regulatory framework is not creating behavior that actually increases at a macro level the problems that we may see but are not, I think, necessarily a true concern for. The other thing we can do is, of course, we can extend a recovery period, and so far we have not been able to, we didn't have a necessity to use that. Now on liquidity. Is liquidity risk a concern for the insurance industry? No. They always tell me not. Is it a concern for the supervisor? We keep monitoring that. And we've done a stress test that actually showed it wasn't, but it didn't stop us from still continuing. It's officially ad hoc reporting, but we do it every quarter already for a couple of years. But we keep monitoring what is the liquidity situation in our industry because we need to be aware. And here comes some positive news, and I know also Francesco was happy that we were able to also, in the review of Solvency II kicked in 2016 with a few of these macro elements, but in the next review that is now almost finalized, hopefully it's published end of the year, we actually add some additional macro tools focused on liquidity to the supervisory framework of insurance. And I'll mention them. They're mostly Pillar 2, by the way, and enforcement. And I think the last part is very important. So in their own risk solvency assessment, Pillar 2, they will now also have to show macroprudential concerns. That's a new requirement. We didn't have that. They need to integrate also macroeconomic concern in the prudent person principle. So that is how they invest, where they invest, how they manage that. And finally, and I think this was a really good achievement, not everyone was happy at my table, but we did reach a compromise, liquidity risk management planning. I think that is also very important. And in the same vein, after the crisis, the gilt crisis in the UK, which we studied, it's not something that can happen in that form in the EU. Our markets are much deeper. We have different sovereigns, and even the largest group of pension funds in the EU is still smaller than, it's still a different kind of entity than what the UK had. But never say never. So also here we ask now pension funds to do stress testing and make sure that they understand what their liquidity risk is. Then I come to enforcement. Enforcement, of course, I mean, it's nice to be the eagle and then zoom in and then you have your problem and then you want to act. You need to be able to act. And so here we will be getting some new powers under the new Solvency II. We will get actually the ability, if we do all these assessments and in the ORSA and etc. and the stress testing, but if we have a finding, we can actually now enforce also that undertakers then reinforce their liquidity position if we see that that is insufficient. We can also suspend the redemption rights of an insurance policy. That is very impactful, so you need to only use that when really necessary, but we can also, in the capital area, so we can impose additional requirements if we have reason for that. And finally, we can do preemptive recovery and resolution planning. So what you see, if we have strengthened on the macro part, particularly with a focus on liquidity risk, the framework that is upcoming. And I think that is very helpful. I also think, and that is the caveat I want to make, that this is all within the context of insurance supervision as we know it today. And there, of course, a big difference is that banking supervision is a European supervision with, of course, a lot of support and work in all the member states, but the end responsibility, the competent authority is here in Frankfurt. In insurance supervision, the competent authority is the authority in each member state. In each member state. And EIOPA has the authority to, if we think it's necessary, to recommend to that member state that they should act, but ultimately it's the member state that has to act. And so whether it is sharing of data, reaching conclusions, but also enforcing, particularly from a macro perspective, that will always, in the current context, but maybe that is something we should discuss, that will always be a joint effort of a supervisory community that sits on my board, and that is EIOPA. And I'll stop there.
Thank you very much, Petra. And let's turn to Steffen, another decentralized authority. It's your turn.
Thank you, Luis, and thanks for the opportunity to also shed light on some of the questions we're discussing here from that very specific ESMA perspective. And by way of complementing what Petra just explained about EIOPA, we have exactly the same perspective on these non-bank financial matters. It's, from our perspective, a matter of the wide coverage of the institution. In our remit, we have asset managers, we have central counterparties, we have much of the market activity, including stock exchanges, trading venues, credit rating agencies. So we have a number of these entities that play a role in what conventionally is associated with non-bank finance, also with banking, by the way. And so you can already see that we are with our remit right in the middle of that very big and important discussion. And pretty much like EIOPA, we're not alone in this game. We are fortunate to rest on the extreme competency of national authorities who actually do much of the on-the-ground supervisory work, for example, on asset management and other things. And as an institution in Europe, as ESMA, we actually directly supervise only a very limited area of market activities. And that is in particular a part of the central counterparty community, but also trade repositories and derivatives or credit rating agencies. But that's very limited. In all else, it's a cooperation game with the national authorities, and then when it comes to these macroprudential and systemic questions with the ESRB, and let me take the opportunity at this point to commend the ESRB, Francesco, and all the colleagues in the room for the great opportunity that this organization gives us to come together and cross-sectorally discuss many of these issues, and not just discuss, but also have very concrete actions. Like when we, Petra and I, for example, talk about stress testing, they always rest on scenarios that are provided by the European Systemic Risk Board. When we talk about much of our regulatory activity, more often than not, we consult previously with the European Systemic Risk Board, and our risk assessment in any case is a great cooperation amongst us. And the ESRB, for example, publishes on non-bank financial intermediation a fantastic document, the non-bank financial intermediation monitor every year. And I say fantastic because I'm involved in the production. And I think discussing these NBFI matters today happens naturally at a very important juncture in the policy process, right? On the one hand, we have at the moment, in particular in Brussels, of course, the discussion on capital markets union or savings and investment union. Lucy already mentioned that, and the various reports that have been published, and the perceived need to actually mobilize much of the capital, much more of the capital that is here, that is in the markets here, and that is in cash and deposits, and that could be used in other ways. And then at the same time, we've got the macroprudential review by the European Commission going on, which is particularly on non-bank financial intermediation, where the question is asked: so, can and should we have a much more enhanced macroprudential framework, in particular in the NBFI space? And of course, the natural question that flows from that is that actually a contradiction, right? I mean, if we want to make markets grow, capital markets grow in an SIU context, for example, and we need to unleash these powers, that always smells like a deregulatory exercise, which it might actually be. And isn't that in a contradiction when we then say, oh, and macroprudential, and I guess from our perspective, from my personal perspective, it is quite clear that capital markets union, savings investment union, and a sound macroprudential framework are actually consistent and mutually reinforcing in the final analysis. When we try to enhance this capital market participation, we naturally, and we want to bring in and mobilize all this capital, it is about investors, at the end of the day, final investors, and retail investors in Europe. And we know the figures, 33 trillion in financial assets held by households in the European Union, of which 1/3 is then bound in cash and deposits, and all of that, you could imagine could come into an investment, a wider investment context. And when you then look at Eurobarometer outcomes and you ask what keeps people from investing in capital markets, the two most important answers that come is, first of all, the risks, and second, potentially low returns. So creating trust in capital markets is a big theme if you want to mobilize this capital, if you want to bring that up. And financial stability is, of course, then the key component of creating that trust at the end of the day. So this is a very important story to bring in, and where we need and can make progress. Of course, thank God, we're not starting from zero. We've got, from a macroprudential policy perspective, also on this market side, we've come a long way. We've got the institutional cooperation that I already mentioned. We've got the monitoring exercises, the stress testing, policy cooperation, which has yielded joint recommendations with the ESRB on money market funds, for example, on open-ended funds and what we can do about liquidity, mismatches and leverage. We also have actually a concrete instrument in the asset management world which can be used as a macroprudential tool. It's on alternative investment funds. It's called Article 25, and that is a tool to limit leverage buildup in alternative investment fund. And it has, as it happens in the last 18 months, been tested on 2 occasions and served us pretty well. And naturally, of course, the question is, and I get to that in just a minute, what else we can do with this instrument and whether there is an opportunity to actually make progress. The outlook on all of this is that we believe, and we are in the process of also drawing up our own thinking on the macroprudential review. So far, we've got the impression that this will be an important exercise to make concrete and risk-based progress in many of these areas, building on the framework that we already have. And all of this happens, of course, against this growing and dynamic market. We now have twice as much volume in non-bank financial assets as we used to have after the financial crisis. Funds today are 3 times the size than after the global financial crisis. And the whole system has grown much more complex and intertwined, and with that comes then the holy trinity of risks in non-bank finance, liquidity, leverage, and interconnectedness. In that risk-based approach, in the past, we have spelled out, we have been risk-based, so we have really narrowed down the focus of both the analysis but also the policy making on those funds, for example, which are particularly vulnerable, and we identified together with the ESRB real estate funds and corporate bond funds, for example, but also high yield, and we have together applied the tools that we have. Now, going forward, there are 3 areas where at ESMA we're discussing, and we believe we can actually make tangible progress in the matter. First and foremost, it is about money market funds, a very important segment of the market, just not only because of its size, because here in particular for its interconnectedness, money market funds connect the banking world through the money markets and money market instruments like commercial paper with the market world, with the fund world. And making progress on money market funds is one of our priorities. We've had recommendations in that regard together with the ESRB in the past, and we, of course, would be looking forward to having, in particular, additional rules around the threshold effects of low volatility net asset value funds there. This is very concrete things that can really bring us in our macroprudential work forward. Second, liquidity. In particular, looking at the fact that we still have a number of areas where funds are open-ended, have an exposure to very long-dated or long-termed financial assets and non-financial assets, and offer daily liquidity, and that sort of awkwardly fits together, or in fact it doesn't really fit together. And one of the big questions here is what can be done actually in order to fix or address this issue. Extending an Article 25 framework like we know it in AFMD might be one solution, but we're discussing other things. And the third area that we have is, of course, leverage. There is still significant leverage throughout the asset management universe, not just in alternative funds. We also have so-called alternative UCITS funds where quite a high multiple of leverage can in some cases actually be observed, and we're discussing solutions as to how this can be addressed, and to ask the question, what might actually be the consequences of this high leverage in our remit. Now, of course, I'm ending on the most important point of all of this. Markets, in particular, the markets that we deal with, so we include also derivatives markets, repo markets, trading, and so on. It's naturally a global business, right? So we can't afford just to, not least of all, look at it from a national perspective. We need the European perspective, but also the global perspective. So we do all of this in close interaction with the FSB and IOSCO, and in that context, look forward to actually then presenting our contribution to that very important discussion of the macroprudential review. Luis, back to you.
Well, thank you very much, Steffen. Let's go to the academic segment of the panel, and we will start with Javier. Javier, your thoughts.
Thank you very much, Luis. I think I'm going to try to make remarks within my available time. I will stop whenever I run out of it, and keep the rest for the discussion and the possible Q&A. Maybe as an academic, as you said, I should start maybe going back to the basics. No, we are talking here about macroprudential regulation for the non-bank financial intermediaries mostly, although beyond banks could be interpreted in a much broader sense to include also the considerations that the president was making in the introductory remarks today about geopolitical risks. In a sense, this is also a risk that goes beyond classical bank issues. So I want to start with a reminder that out of the many regulations that we have in the financial system, this conference is about the macroprudential part, and the macroprudential part, which is sometimes difficult to separate from the microprudential part, is about financial stability. I think in the old days we thought that by having individual entities of each class safe and sound, we could have the system stable. Somehow the lessons of the global financial crisis were leading us to think this is not enough, and the example about the fish and the fishes moving all together is very relevant. Maybe one single fish does not produce a crisis, but if all of them do the same and get into the trap, this could be a problem. Now, in the context of a regulation beyond banks, we are, as Steffen and others pointed before, in an extremely rich and complicated environment. I mean, banks are already complicated, but if we think of anything else than banks, this is a wide variety of entities, institutions, activities, and markets. Well, markets are specific institutions. What is the goal for the macro-pru policy in this field? To keep the functions of the financial system operative in adverse scenarios, to make sure that shocks to the real economy do not get transmitted and amplified through the financial system. To the extent, in some cases, that the financial system becomes, through runs or through fire sales, actually the source of shocks to the real economy. So we are talking about something which is important and at the same time complicated. So I have a tendency to think that we need to make progress gradually. So the degree of ambition that we can have to address these challenges needs to be proportional to our knowledge about what are the relevant mechanisms and evidence of the potentially quantitative significance of mechanisms that are easy to imagine, but maybe in practice not so relevant. So I think we started an evolution from a bank-centric macroprudential policy to beyond. And the first, and maybe Steffen really remembers, because his report was called the Shadow Banking Monitor, right? So the beginning started like there are markets and especially institutions outside banking that are doing bank-like activity. So we started thinking that the type of activities beyond banking that needed to be subject to macroprudential or even prudential policy were the shadow banks, those that look like banks. Why? Because we knew that banks are very dangerous in terms of potentially provoking financial crisis, and because the global financial crisis was one in which this shadow banking system played a key role. But now, maybe out of the political incorrectness of the term shadow banking, we have broadened the scope, perhaps too much, because now anything that is not a bank is not a non-bank financial intermediary. And when I heard we need to do macroprudential policy for absolutely everything beyond bank. I feel very nervous because a lot of what is beyond banks is not properly known. So I will say I fully support the idea of filling the data gaps, but then the next step will be doing a lot of analytics, a lot of research to find out of that complex world what are the real imperfections that in terms of relevance and significance, not only at the statistical level, but also at the essential level, require our attention. I was reading just today a working paper from academics suggesting that monetary policy decisions have a channel of transmission through mutual fund redemptions. And the study makes an abstract suggesting this is a very important and novel monetary policy transmission channel. But the results, when read in detail, although the authors call them significant, are that in the surroundings of monetary policy announcements, there are variations in the flow of redemptions, in particular when monetary policy ties redemptions in the mutual fund sector. Redemptions increased by 0.1 something %. Is this really a type of quantitative effect that will deserve macroprudential attention? I have doubts. So I actually will insist that a solid case for macroprudential policy beyond banks needs to be made before trying to touch every possible activity or entity beyond the banks. And this is connected to the previous remarks on on the capital markets union. I mean, the system is risky, but risk is necessary for investment, innovation, and growth. We cannot hope not to have risk in the system. If we don't have risk in the system, we essentially kill the system. And in the context of the European Union, the Draghi report was very clear on how many challenges we are confronting in terms of financing climate change or the adaptation to climate change, on the need to invest in defense, invest in innovation, and how important, in a sense, going beyond banks, although banks will play a clear role in this world as well, requires a very active set of markets and institutions for the channeling of the savings towards the relevant investments. I'm worried that through arguments that make sense on the need to extend macroprudential policy beyond banks, in the current European Union context, we end up adding a layer of nationally heterogeneous macroprudential policies that further complicate the very complicated already, because essentially we have 27 different regimes for each of the subsectors in which I can divide the non-bank financial intermediaries, that in my view will be an obstacle to the development of the capital markets. So is there a conflict? Well, if we make policies directed to enhance the trust of the investors in market and institutions, this is definitely a good thing. But that sounds to me more microprudential than macroprudential at this stage. So I think the case for macroprudential can be made and should be made, but I will argue that the true challenge for capital markets union, and therefore for beyond banks in Europe, is about harmonization. So no laxer regulation. I'm not saying we don't need macropru, but if we add macropru, let's add macropru without adding excessive complexity. Should be a very carefully standardized and harmonized limited set of tools, also because I think that the policymakers need to keep focus. I may elaborate later because my time is out on these points, but I think these are some provocative thoughts for
Thank you very much.
discussion.
Thank you very much, Javier. That's a very good point. I think that, if you read, the Letta and the Draghi report, they say very clearly that we have to eliminate red tape, excessive regulation, and perhaps, here with the Capital Market Union, we should avoid that for sure. That's a very good point. So, Dimitrios, your 10 minutes.
Thank you very much for inviting me. Thank you for the old and new friends that in the audience and virtually or physically. The discussion so far has brought me back to my initial involvement in financial stability. When I was at the Bank of England and had, because the ones who know my work, I work with models, I work with equations, and I avoid opaque statements. And at the time I was back in the late 90s, when we didn't have a clear view about financial stability, as a good student, I asked the question, what is financial stability? I remember vividly in that room, there were 4 people, including me, 5. There were 7 definitions. So from that point on, we have gone a long way to define what is the object of financial stability, of microprudential and macroprudential regulation is. Now, speaking about macroprudential regulation, I will invoke the Timberian principle. Microprudential regulation follows the onset and, if you will, the revelation of new externalities, pecuniary or otherwise. As the President told us before, already we have the technology that presents us with problems. Markets are incomplete with respect to all of these new technological issues that have emerged. We have the climate finance and the climate risks, physical risk, transition risk, inequalities that emerge from physical and transition risk, gaps, polarization between the global north and the global south when we deal with transition risk. All of these things call for new tools. And as Timberian would argue, as many externalities we have, so many macro-pru tools we need. Hence, it's not a matter of whether we have excessive macroprudential regulation or deficient macroprudential regulation, is to have the right amount of macroprudential regulation. Now, this second point I would like to point out, given the global financial crisis and all the shocks that occurred starting in 1997, 1998, in fact, and they culminated with the crisis of 2007-10, and then further on in the Eurozone debt crisis, we focus on crisis management because the shock hit us and we had to deal with. It was very interesting to see in conferences in Latin America during the global financial crisis, the emotional stability of the Latin American governors as opposed to us. They knew the business. They had seen the movie many times. Hence, now the second layer, the second stage is to deal with macroprudential prevention rather than crisis management. Hence, I will throw on the table, which maybe will take some traction in the discussion, a tool that has been has resurfaced, has been used, and we try to shed more light together with colleagues of mine from ECB, Edward O'Brien, Rainer Martin, Chief Economist of the National Bank of Slovakia, Pieris from Oberlin University, and myself, talking about the merits and the benefits of asset management companies as institutionalized symbols of trust or intermediaries of intertemporal smoothing, not only of liquidity shortages in the secondary market of non-performing loans, but also intermediaries about the consequence, as the Vice President said, of leverage, which is default, the forbidden word. It's like sin in theology, never mentioned, but always present. So liquidity and default, they go hand in hand. And asset management companies, given that we have exhausted, so to speak, or we have used a lot of our regulatory tools during the global financial crisis and the Eurozone debt crisis, outright monetary transactions and conventional monetary policies and so on and so forth, it may be something that was used successfully in the Ireland, in Spain, 16% of the GDP in the Ireland, I think, is over 40%, the NAMA in Slovenia, 10%, and even before in Malaysia, Korea, one of the pioneers was Sweden. It was a very successful tool of macroprudential, of crisis prevention, if you will, and basically it limited defaults, it enhanced liquidity, and when properly managed, it also reduced the moral hazard and the adverse selection dangers that exist in the establishment of this institution. Basically, this kind of a tool, one of the reasons that many people are reticent, despite, I think, reports from the ECB and the 2017 EU Council Action Plan that they noted the merits and the benefits, but because there was not an analytical and systematic analysis how this fits in an analytically coherent framework, that's why people, I think, and policymakers in particular are reticent. So we tried, the four of us, to embed an asset management company in an otherwise plain vanilla standard. That's now the new game in town, DSG, or a neo-Keynesian model, to see with and without the asset management companies, what would the impact be of such an institution. We find welfare gains, we find lower default rates, and we find a benign cycle of the bank lending channel and the corporate sector balance sheet channel, because when you ease lending, as we all know, conditions, then corporates can borrow easier, can invest more, can enhance the profitability of the banks, and so on and so forth, and that feeds back in the economy. Evidently, the key question in this is how these objects, these institutions are financed. They can be either by sterilized monetary transactions or fiscal transfers. If properly managed, given the intertemporal nature of asset management companies, then they can take the NPLs with prices below, but not much below the real economic value, but above the market value, and prevent temporary liquidity, perhaps, to turn out to insolvency, and as Javier and others have argued, bank runs, and so on and so forth. Hence, a proper study and the results that we have already, and in order to enhance the level of my policy proposal, there will be a policy brief note in SWERF arguing exactly this point, that the welfare gains, if properly managed, of asset management companies will be non-trivial. Moreover, putting my other hat, when I tried to contribute to save the sinking ship of my own country back in the Eurozone debt crisis, evidently not very successfully at the time, now a covered up asset management company has been in place when you deal with non-performing loans, the Hercules, where you come from, plan, and we have already started seeing the good effects and the good outcomes and how the rationalization and the consolidation of the banking system has started taking place. Something that was not achieved either with the emergency liquidity support or by the continuous recapitalization of these banks. Last but not least, if we start thinking out of the box, we can go across the Atlantic and you will see a dressed up asset management company, a securitization institutions in Ginnie Mae and Freddie Mac. And we see how successful they have been intertemporally. So that's food for thought, introducing this policy to cheer up the debate and the discussion later on. Thank you.
Thank you very much, Dimitrios. Well, first of all, thank you very much to all of you, because you have dovetailed your interventions to the 10 minutes. Perfect. That's very good. A lot of discipline. And now we have, I think that we have 10 minutes to have a sort of discussion among us before opening up the Q&A with the audience. But I would like to ask you about, development that, is not so relevant in the euro area in Europe, but in the UK and the US, that is private equity and private credit, private capital, let's call it. How do you see it? Do you think that, the phenomenon is going to follow suit what's happening in the UK and in the US? Or do you think that in Europe the situation is different?
Shall I go first? Yeah, so we clearly monitor that because, like Steffen also said, we also are very active in the IAIS, which is under the FSB, the Committee for Insurance, where this is indeed through the UK and the US a topic very high on the agenda. And I would say for good reasons. You see, I think you see two things. You see in general a lot of life portfolios through reinsurance, but also through other entities, also leave the US, going to other jurisdictions. That raises questions, and they were first, but also UK identified that. I think in general what you see is in the insurance industry, a few large groups moving much more to a model where they try to maybe even become more an asset manager than that they're making use of the assets they receive through insurance, but then focus on the asset management business. Some are quite successful. These are new models that we need to monitor, and they also happen more in that part of the world. That does raise the question, do we see that here? So we do see private equity come in. We always stress that private equity is not one and the same thing. So there is private equity that says, and so far has shown they have a long-term perspective. But I think we need a little bit more long-term to know if it's really true. And then we have seen those that in the end, definitely as a shareholder, did not deliver and did cause trouble. So I think here that is one thing we monitor. A second phenomenon that we monitor is whether or not it's increasing. Alternative assets currently in the EU are around 15%, but only about 2.9 is private equity. So it is still not happening a lot. One thing we picked out is what we call asset-intensive reinsurance. So an insurer can also reinsure, take an own insurance. It's called reinsurance. I would say from a macro perspective, you definitely want to look what happens in reinsurance. That's where risks are globally diversified. But if that doesn't work, we do have a problem. And if reinsurers have a problem, that impacts the insurer. So this is an area where we need to focus on. And what we see with asset-intensive reinsurance are insurance treaties, reinsurance treaties, where not only the risks move away, but also the assets move away and then are managed by a different entity. And that raises question on where are the assets, what kind of prudential regime does the asset have, but also what is the prudent person principle that is held by the asset manager, and does that align with the risk profile and appetite of the actual insurer?
Very good. Steffen?
I mean, first of all, it's impressive how well this important topic fits with the discussion that we have around here, right? It connects so many dots. On the one hand, it is clearly part of non-bank financial intermediation universe, no doubt about this one. In the European Union, these entities, private equity and private credit funds, are actually alternative investment funds according to the AFMD directive. You can ask the question, Javier, like you had it before, like, okay, here is an up-and-coming market, but does it actually require macroprudential attention? Is it large enough, complex enough, risky enough, and so on? And it actually also connects with the big discussion around capital markets union, savings investment and competitiveness, because it has been said so many times before, in the United States and in the United Kingdom, these entities have been instrumental in the financing phases of companies and have contributed a lot of money, 10 trillion euros in assets worldwide at the moment, this market, of which in Europe we have 2.7 trillion. And out of that, 1.1 is private equity and 0.45-ish is private credit. Now, it is a regulated activity. It is in our monitoring framework about risks, as Petra has pointed out. And it is clearly a growing market that bodes strong promises when it comes to financing opportunities, and at the same time, through its layering, has also a number of risks. I think when we, together with the ESRB, looked into the matter, what we found very important about these two types of entities, and they are very different, by the way, private equity and private credit from a risk perspective, very different institutions. But what we found, what impressed us the most, is first of all the interlinkages with the rest of the financial system. Again, there is banks involved, there is fund entities involved, there is all sorts of other ancillary services involved, and they make use of a number of instruments, including derivatives, repo transactions, and so on. So it's the whole menu of things that comes together. And secondly, the way credit risk is ingrained in these funds and the invested companies and dispersed across the vertical integration of these entities. So from a risk monitoring perspective, a very interesting case that we are right on it, and we'll need to see whether anything more comes out of it and to what extent the market grows.
Javier, you have 2 minutes each, because otherwise we are going to absorb
your
them.
question. Yes, I have 3 points, actually. One, definitely this is an important development that deserves attention. So it goes with my support to the idea that we need to collect the data and we need to do the analysis and the research. At the same time, second thought, it's clear to me that part of the development of, in particular, private debt is the result of increasing regulatory pressure on banks. Now, is this desirable or undesirable? Is intended or unintended? Well, we should expect, actually, that if we care very much about the riskiness of the highly levered deposit-based financial institutions, when we tighten the regulations, part of the financing of risky activities goes elsewhere. And this is consistent with my previous remark that in principle, this is not worrying and should not be seen a priori as a worrying development. So it's a development that requires attention. Let me elaborate a little bit on something connected to this issue. It's commonly heard in discussions on macroprudential policy beyond banks, this so-called principle, same activity, same risk, same regulation. I should warn against the validity of this principle. The principle is a catchy sentence. This catchy sentence was elaborated mainly in the industry and by the banks in connection to the threats coming from fintech and especially big tech. In the origins of the sentence, there is the view that if some non-banks are doing what the banks do, they should be treated the same way. And with that, I fully agree. But I should advise against a too narrow interpretation of same activity, same risk, same regulation. Because then we could say, like, private debt is involved in loans or other forms of credit, and this looks like lending by banks. But to say the truth, I am much less worried about risky loans going into private debt funds whose investors are properly informed about the risk of what they are investing in and where they can be diversified and where the funding of the risky loans is not supported on a fragile funding structure, such as when deposits are taken by the by the traditional financial institutions. So we should not observe a credit risk quality composition of that sector, which will be very worrying in the hands of banks. The light covenants, whatever else we think is a worrying risk development, with the same eyes as when judging the portfolios of a regulated bank. And I think, again, this sector could be key to the development of the capital markets union.
I think I fully agree. You know, sophisticated institutional investors are not the same than depositors. No? That's a good point. Dimitrios, your view?
I agree more or less in general with what has already been said, but I would like to identify the two key questions when we are facing a new asset class or a new market. Number one, what are the externalities that are generated, if and when are generated? So the private equity, does it cause a liquidity externality? Does it cause a default externality? Does it cause a collateral externality? Number two, one needs data for any new asset class in order to be able to assess the impact of the private equity and the private capital externality in the wider economy. Because in the end of the day, I go back to my previous comments, the Timberian principle applies. If there is an externality, then regulation, micropru is warranted. And last but not least, transparency and lack of opacity. The example of what happened in California with junk bonds should never be forgotten. It's a price that people in California pay after so many decades because there was lack of information, things were opaque, and lack of transparency.
Okay, thank you very much to all of you. Now we are going to open up, the Q&A and the questions to the audience, and I pass the baton to Francisco because unfortunately I have to leave. Thank you very much.
Thank you.
So this has been an exceptionally good conversation, and I'm sure there are many questions. We are also forecast via web, so I've been asked to urge all of those who want to take the floor to please present themselves. Most of you are known to us, but the larger public may wish to know who you are. So I have here a request from Abdelaziz. I know that there are colleagues having a mic. Abdelaziz, I think you are getting it soon. Thank you.
Thank you, Abdelaziz Ouaba from Central Bank of Luxembourg. I have a question to Javier. I was surprised by his proposal that capital market union is related mainly to harmonization of macroprudential regulation and centralization of supervision. First of all, I didn't see any empirical evidence or theoretical, from academia, theoretical paper that argue that the centralization of supervision or harmonization of macroprudential or microprudential, whatever, is a condition for the success of capital market union. I think from my side, I think that the other regulation, which is specific to structure of the economy, such fiscal employment, market employment regulation, bankruptcies, this is an important issue for the future success of capital market union. For me, as there is no theoretical evidence for what you said, I don't think this is a residual from my side. It's not a necessary condition for the success of capital market union. I don't know if you share my opinion or not, but I have, as you warned before, for this causality between same activity, same risk, same regulation. I warn you also about this this causality or correlation between macroprudential regulation, harmonization, and the success of capital market union. Thank you very much.
Javier, please.
So thank you very much for the question, because also helps me perhaps explain better what I was trying to say. My first point is I will be careful not to add a layer of complex macroprudential regulations in the field of non-banks. Now, if we are to add such layer, just not to add complication to the already complicated European regulatory landscape, I will try to introduce that policy in the most possibly harmonized way. Now, I don't know any paper that says what you say will be supporting my claim, but this is based essentially on some potential general principle. So let me try to explain. If banks have been subject to supervision at central level, basically for the euro area plus through the SSM, I think in the case of non-banks, the potential case for centralization is even bigger. And I'm not saying I postulate centralization, but the potential case for centralization is even bigger because a lot of the non-bank financial intermediation is much more global and cross borders than bank activity. So I don't see strong reasons for the specificities of a liquidity management tool if we talk about money market funds or a liquidity requirement with a macroprudential goal in the background to be extremely national specific. I cannot imagine which domestic developments call for having a design of a tool different from another country in the same union. But this is not saying that I am defending that macroprudential policy for non-banks should be centralized. I say this is a potential argument for centralization, but definitely is a potential argument for harmonizing the toolkit, not necessarily the playing with the toolkit, which, I mean, this will depend on the whole architecture of the supervisory system in Europe, which is a very challenging thing to touch. Thank you so much.
Thank you. We have a request here from Luigi Federico Signorini. The microphone is on the way.
Thank you, Federico Signorini, Bank of Italy. I also have a question for Javier, probably from a slightly different perspective. I entirely agree that the adding further layer of heavy regulation is not, in itself, is not a good idea. And I also agree, of course, that there is a difference between banks and also insurance companies that are institutions that manage other people's money, but on their own balance sheet, is a different case from asset managers or funds and things like that. But here is the point of macro-prudential regulation. Now, macro, we use the term in different senses. For instance, what is macro-prudential regulation in connection for real estate is one thing. It applies also to banks, it applies to insurance companies perhaps, and it does apply differently in different countries. But in the case of asset managers, funds, and similar institutions, the basic concern from the macro point of view, in my view, is the market developments, the school of fish kind of thing, that the school of fish might go, everyone might go in the same direction at once, and even then, they may do that for good reason, because a shark has appeared, and in that case, there is a clear connection between the markets going in all of a sudden in one direction and the fundamentals of the economy having changed. But the issue is herd behavior or school behavior, if you want, self-fulfilling prophecies, bubbles. That's the kind of thing that I tend to think about when I think about macro-prudential regulation of non-banks and non-insurance companies, frankly. And I think this is something that does apply to them, not to the institutions that require micro-level supervision like banks and insurance companies. So back to basics. Professor Suarez, am I wrong on that?
No, you are totally right. I think back to basics, when I elaborate on my criticism to the simplistic reading of the same activity, same regulation principle, I will say when assessing the activity cannot be assessed in isolation. The activity is part of a portfolio, is part of an asset. But moreover, the activity has a liability structure funding the activity. And then I say from a macroprudential perspective, and I think here we are totally aligned, actually the risk to the system that a particular bundle of activities developed under a particular liability structure poses to the system depends on how the entity in particular is interconnected and which type of trading, transactions, financial contracts develops with the rest of the system. So this makes the problem extremely challenging. So herd behavior is one issue, but probably is not necessarily the most important one. So when talking about the private equity or the private debt, how will these fund managers react to shocks? We know, thanks to a lot of empirical research, how typical loan officers and risk managers at banks react to shocks, because lots of the attention is being focused on that. On the private debt and private equity, we still need to investigate. But there are some indications that some of these sectors that might look worrying on paper are actually like fish going in the opposite direction to the banks, which would then create a counter-cyclical force, right? So I was navigating two papers from the Federal Reserve Bank of New York researchers this year on the topic, not necessarily providing consistent messages. One was saying the border between bank and non-banks is extremely tricky. The title says something that we don't know when banks end and when markets start. The bank might be facilitating the origination of some of the loans that end in the CLO that end in the hands of an asset manager. And this is interconnections, and we need to pay a lot of attention to it. So my call is not to pay attention to them, but to be very careful to elaborate a good case for it. The other paper was, in contrast, looking at historical evidence from the US for a long time period, documenting that actually the credit booms in the US were private credit and not bank credit. So non-bank private credit was the force in the boom, didn't end in financial crisis with as high probability as when the credit went with the bank. So in a sense, there are these communicating channels that I fully agree are important to understand and potentially regulate when we know how to do it. But I will not know very well how to do, say, counter herd behavior, except actually with the very powerful tool that goes through all the cracks, which is monetary policy and all these extraordinary actions, no, that we regret so much to have to do from time to time to stabilize the markets and to provide market making of last resort when it is needed.
I have a question from the gentleman over there. The microphone is behind you.
Thank you very much. My name is Dirk Zetsche. I hold the LLM in Financial Law at the University of Luxembourg. I'm a member of the IMSC working group from ESMA and of the crypto asset working group of the ESRB. I have 3 comments to make. The first is we should keep in mind that the AIFs in Europe are probably the most heavily regulated AIF sector worldwide. And that's why Steffen Kern can present this data, because these data would not be available in the other markets. Why is it important? Because the risk I see is not so much from the investment inside the European single market, but the spillover risks from the other markets. There is where maybe some difficulty lies. And when we also look at the discussion that Javier has kindly mentioned, these are from the less regulated US markets. Yeah? So here I'm thinking there's a spillover risk. I don't see the risk necessarily coming up from the bottom of the EU markets, also because ESMA with Article 25 is a wonderful instrument to mitigate that risk. The second, and this goes to another picture Steffen has kindly mentioned, the triangle of leverage, non-bank financial institutions, and interconnectedness. I want to add 2 more factors, which I find extremely important. The one is profitability. Usually leverage is a result of lack of profitability. If we have profitable investments, we don't see the sector leveraging up. So here I'm thinking the profitability factor is really important, and where we saw leverage heavily used is in particular when we see the very low interest rates in the last years that have basically created unhealthy structures. So there is an interconnectedness in that sense that the interest rate policy must be sound, and then we see less of these instances happening. The other aspect is growth and innovation. Growth and innovation from the investment perspective is a volatility aspect. Yeah? It can be extremely profitable, but it can also be extremely unprofitable. And here now this goes back to what I think both Dimitrios and Javier mentioned. Risk is inherent in investing. If we don't have investment risk, we don't have profits. And that means we cannot pay pensions. So there must be something like a commensurate, adequate level of risks so we're able to pay pensions. Otherwise, we will earn less than the inflation rate, and then we don't need to invest. Then we have only the cost of financial intermediation. And this is, I think, also to be considered in this type of triangle, which is now a fifth angle, so to say. My last point, private debt. Private debt is, of course, necessary from the non-bank financial institutions because the banks don't lend to SMEs. That's just a fact. And when banks don't lend to SMEs, now we can say, let's forget the SMEs. Unfortunately, they make more than 35% of our jobs. So who can lend if we are too strictly on these type of private debt structures? And I'm thinking it's better to basically go for the fund structure, which is usually funded in the sector from the sophisticated investors, as Luis mentioned, rather than retail investors in the form of depositors, which come through banks. So here I think the private debt AIF sector is the place where this risk should be. And this is also where, in the structures that I'm aware of, and I'm part of a board member of a private debt structure, I can just tell you, finding good investments in this SME sector is extremely difficult. And who can find it, if not specialized investors in this field? Thank you very much.
Thank you very much for the three questions. So who would like to respond? So Steffen, perhaps you have been mentioned a couple of times.
And thanks so much, Dirk, for these 3 points. Super interesting and very topical in the discussions that we have. I will maybe go into, in particular, the AIF question as a comparatively strongly regulated market in the European Union. And let's keep in mind that alternative investment funds under this regulation are a very diverse field, right? Actually, the largest part are real estate funds. Real estate funds in the European Union need to be signed up as an AIF, not as a UCITS. And this is what actually constitutes the highest part of that, the largest part of that segment. Ironically, and in particular after Brexit, hedge funds play practically not a significant role in that segment anymore at all. I think we're just about 600 billion worth of assets there, insignificant now. And in fact, we have more, in as far as this is measurable, more leveraged funds under UCITS than we have under AIFs these days. So leverage is a topical issue, and AIFs are a very interesting field. Of course, within the substructures of AIFs, you get multiples of 20 plus in terms of leverage, and this is something that is a priority in the supervisory and regulatory work, no doubt about this one. Now, your point was about the spillovers from other segments, and it reminds me of studies in which also ESMA had engaged in the past years. You actually see quite a strong cross-correlation in positive correlation in investment activity of hedge funds across borders. That is an empirically very interesting fact. So these spillovers can be real. Even though in terms of magnitude at the moment they haven't been so overwhelming. And that might be related to the fact that in particular US but also Asian hedge funds do not have in their portfolios maintain high shares of European assets to start with. It's actually the other way around, that European alternative investment funds go international in their portfolio allotment, right? So this might be a thing, but it's certainly worthwhile having an eye on the point. Thanks for actually enhancing the number of factors that we need to take into consideration. I took note. Now we've got 5, and certainly profitability. is a super important aspect, in particular because it also correlates with the other factors. So very much agree with that one. And the remark on private debt, I think that was not a question, that was a remark, right? And so I don't need to comment.
Thank you very much. Anybody else who would like? Please.
Maybe, if I may, because a lot has been said there for this, the need for risk, and I agree with that in the sense that coming from the authority that I have, we see that 1 in 5 Europeans will live in poverty at the moment. We see that pay-as-you-go systems governments, currently about 47% of a pension will drop to a low 30%. We have a problem. And a way to make sure that we deal with that, and here comes the Capital Markets Union, is indeed if citizens, European citizens, are willing to use part of that deposits in banks and to start investing that. And that can help them for a better pension. It can help the economy. If you then zoom in, we need to be careful because, and you said it, why do people do not like the risk? Where is the trust? This is what we need to build better because we can create a structure where we can tell everyone that it would be great that they do this, but in the end it will, and then not the retail investor, but an institutional investor can do the investment and etc. But we first need them to move that money. And how is that going to happen? Now, tax incentives is of course a way to do it, but for this you need policy decisions that I think are based also at government level on a 3-pillar view on how the pension is organized, the occupational part, the investment part, retail investment part, and the first pillar. But moreover, I think you need to understand that from an individual citizen perspective, they have a guarantee of 100K on their bank account. They have the ECB in Frankfurt and it supervises. And I'm not saying that currently insurance is not safe. We are a very robust industry. But at the same time, the feel for that product is different. So some thinking about insurance guarantee schemes or ways, mechanisms to actually deal with some supervisory issues or supervision at a new level might help to also convince citizens that you can move, you will run a bit more risk, but there is a there is a net to catch you. And meanwhile, because I do think overall for the EU economy, it would be a better use of the capital we are already saving for our future, individual, but also as an economy. So to add that.
You have a really very short time, unfortunately, we are already on the negative side, but please.
7 seconds. With respect to the management of risk, there is a trade-off on the one hand to avoid moral hazard, to avoid adverse selection on the other hand, not to kill the risk-taking behavior of investors. Hence, how you manage and how you regulate this is context-specific. And that's why one has to be very careful when we try to avoid regulatory arbitrage, not to fully harmonize and create a level playing field that may inadvertently hurt certain economies, certain economic conjunctures, and not the others. So different horses for courses.
Thank you very much. I have the impression that with such a good panel, we could continue for a couple of hours. Unfortunately, it's not possible, so I would like to ask you to pay a tribute with an applause to all of them.